Hey guys. So the name of our panel is literally Public Miners What Happened? And undoubtedly it has been a tough time to be in the Bitcoin mining industry. I think about, from 2016 to 2020, the amount of time that it took for companies to run out of money and then subsequently go bankrupt, it was a much longer timeline than what we've seen in this most recent bear market. And I'm wondering, is that partially to do with the fact that there was just so much more over-leveraged issues involved this time around? Or was it a perfect storm of, rising energy costs, the dropping price of Bitcoin? Like, literally, what went wrong last year from each one of your respective, views?
Started off, I guess. It's been a tumultuous time for everyone, not just in the Bitcoin mining industry, but it was really a perfect storm, as you mentioned, of higher power costs, lower revenue per kilowatt hour on the mining side. And so when you coupled those both together, it created kind of this issue where there was a big risk for US dollars versus Bitcoin for mining companies, because they're mining the same amount of Bitcoin, but a lot less US dollars. So from that perspective, it created this big leverage issue in our industry that you saw play out really at the end of 2022. And I think there's still this kind of overhang in this industry that we'll see on a go-forward basis throughout the rest of 2023 as well.
Yeah, I think it's, for one thing, people have short memories in this industry. And those that did remember thought, if I can scale faster than anybody else, then I'll be able to take advantage of mining Bitcoin. You had the China drop also in hash rate, which drove even more desire for people to get stuff online. And when you think money's easy, you never think that that's going to end. And there were a lot of people who raised a lot of money, went out and invested in infrastructure and said, I'm going to go back to market, get more money when I have to finish building this out. And then money started getting tight, and issues started coming up, and people were now all of a sudden financing machines at 11, 12, 13, 14%. And when Bitcoin price drops and energy price goes up, it all kind of collapses. And so it was the people didn't have the financial wherewithal or the sort of prudence to have a good balance sheet that unfortunately overextended themselves, and then it kind of spirals from there. So.
Yeah. So with everything that happened, from what they said, I won't go into all the details because there was a lot, but I think at the root of it is that hope is not a plan. And I think that that's really what was happening. There was a lot of hope in the industry. There was so much potential, but you need to plan on both sides of that potential, the potential for things to go really well and the potential for things to go really badly. And when it came to the leverage in particular, leverage doesn't behave very well when things go really, really wrong. And the convergence of the drop in Bitcoin price with the increase in energy price, it really created that perfect storm. And so I think that's what it is if you plan for the worst and hope for the best, it becomes a real plan instead of just hoping for hope's sake. And I think there was a lot of that.
Yeah, and Adam, right now you guys are, working your way through bankruptcy court, thinking about how you restructure core, relaunch. Like, what is the plan there? How are you rethinking the way that you do business?
Yeah, I think it really comes down to the fact that at our core, our operations have been extremely successful through the bankruptcy process. It's really hats off to our data center techs through the software team. We've continued to mine at a very exceptionally high level. And so when we look at how do we kind of get through this process and what do we look like when we emerge, it really comes down to managing the Bitcoin US dollar trade much better. And so that's an area that I know everyone on stage here has been looking at really closely, is ways that we can manage our margin profile in a much more proactive way, because historically that was never the focus. We were always really focused on just mining more Bitcoin, but on a go-forward basis, it's really about risk management and focusing on how do we ensure that we can produce free cash flow on a leverage basis to ensure that we can always pay our debts.
Yeah, and in terms of that idea of, Zach, something that you were talking about before, this idea of risk management and when, having to plan ahead to when you're not at the height of a bull market. I think of CleanSpark, and you guys raised a lot of money and you waited to deploy it. And I'm sure at the time that was at the expense of market share. So walk me through your thinking and your strategy and how you timed when you bought gear, because you've also recently made a lot of big acquisitions of public sites. So what was the thinking there? And also, how did you not get FOMO, not expanding more when things are going really well?
Yeah, no, that's a great question. And, 2 years ago, I actually gave a presentation, and the title was The Last Kid on the Bus. And it had nothing to do with actually being the last one to join or missing out. It had to do with perspective. And I think that the time that we entered it gave us an interesting perspective. Bitcoin hadn't quite risen yet, but there was already people making big investments. And so we actually missed our first opportunity to make a big investment while it was still down before price per terahash ran away. And kind of seeing the true contrast and how ROI works, every decision we've made ever since has always been about return on investment. The other thing that we paid really close attention to is time that capital is out before it returns. And that's been the number one thing for us. We've been very willing to be patient because it's not just a measure of what a machine costs, but what does it cost between the time you pay for it and when you can plug it in? Because that capital is gone until that plugging in event happens. And so we worked really, really hard. We went into the spot market. We didn't place big headline orders about 20,000 machines, 45,000 machines like we just did in the past, because the time to pay for it, to plug it in, was too far. What we have now is we waited long enough. We've been making bold predictions about the price drops on a price per terahash on the XP in particular. And everything kind of converged perfectly for us to make a really big order, but it's because there is machine availability. So the time between paying and plugging in is still our number one focus. And so that's how we look at it when we build up our capital. When we deploy it, it has to return to us quickly, not just return to us well.
I think, just a comment on that, it's really hard to time the markets perfectly. I think you guys have done a great job. We placed our big XP orders at the peak of the market, but with price protection, so we had that protection all the way down. But you also have to look at you need to get machines online so that you can take advantage of the conditions in the hash rate, global hash rate, before the halving. And I think you could reverse engineer the timing to be almost perfect, and the challenge is that what that really means is you need to be turning on machines in the depth of winter, running up into the halving and beyond, and then focusing on efficiency.
And I really do want to dig into the halving in a minute. But before that, I mean, you guys operate different business models. You've got the asset light model where you don't own infrastructure or employees. There's a self-mining side of it. What has worked for you guys? And I'm not even talking about preparing for the halving next spring, but I'm just talking about getting through this latest storm. Like, how did you think about your strategy in that sense? And when I've got Zach's perspective on that, but Fred, I'd love to hear a little bit more.
Yeah, I mean, our model is a portfolio approach. So if you go back 2 years ago, we were in a market where capital was nearly free. You could raise as much money as you needed if you had a good float in your stock. And it was a market that really was all about accelerating. And so if you were to look at a site, building a site yourself, you had to tie up the site, you had to get the energy contracts, you had to spend about 30% of your CapEx on infrastructure and then 70% on miners. And we said, if we can find sites that are ready to go live and just invest in the miners, we're willing to pay a higher price for the hosting overhead because we don't have that CapEx. So we did that with our initial deployments. Our model now is a hybrid where we have some third-party hosting when we can get time to market, where we'll just, if we have extra capacity we want, we can contract it very short term, get it online. Where we're looking for efficiency perspectives, low cost, we're building. And what we're doing is, slightly differently than other people, we're building a tech stack that gets us the efficiency. So what we've done in Abu Dhabi, for example, is taken a Bitmain XP, put our firmware on it, our own controller boards. It's a hybrid type of immersion technology, run using our own pool, and that system has run in ambient 47 degrees C with lots of humidity flawlessly for months without engineers touching it. So that means very low operating expense for the site. Plus, we can overclock and underclock the machines based on electricity pricing. So we've been very focused on how do we maximize the impact of our technology on the solution so that we can operate when prices are high, we can operate when prices are low, and we can operate when conditions are bad, and we can hit the throttle when we really want to.
You know, Bitcoin is up more than 60% year to date, but it's still well off its all-time high of almost $70,000. There's still a lot of distressed assets out there. What does M&A look like in this space? And, you know, Adam, is it something that you guys are thinking about? Like, what makes sense? Do you relaunch as core? Do you partner up with somebody? Like, who rolls up to who? How is this industry going to change in terms of corporate structure?
Yeah, so before I joined Core, which I just joined Core about 5 weeks ago, but before that, I worked at a firm called XMS Capital. We were the largest investment banking team focused on Bitcoin mining. And that's an area where over the course of 2021 and in 2022, a lot of deals, a lot of M&A fell apart through that time period. And it was partially driven by the fact that when a potential acquirer was looking at the target, they were like, well, this target potentially runs out of money in the next 12 months or the next 18 months, and it brings credit risk onto our balance sheet. And so it became a real business of just looking at the individual assets inside of companies versus full company acquisitions. And so that's why I think when you look at other companies in the industry, you know, it's really difficult to understand which ones are still going to be around 24 months from now, because there's 20 some odd public companies today. But in the future, there's not going to be 20 some odd companies. And it's what is the pathway to get to 5 companies or 10 companies? And a lot of that's going to be sale of assets that actually have value over the long term to larger companies. And besides that, you're not going to really see these big M&A transactions because they just don't make sense when you look at the income statement, the balance sheet, the whole M&A model. It just doesn't really play out the way I think everyone else thinks it's really going to play out for us.
I think just the challenge is in traditional industries, when times are bad, you can pick up an asset for a lot lower than its replacement cost. Mm-hmm. In our industry, everything drops in price, so the replacement cost drops with the asset prices. So our philosophy at Marathon is if we can find energy assets that have good energy pricing, good infrastructure, we don't care what machines are in the facility because we're going to throw them out anyway. And so if it gets us faster to market than building it ourselves, we'll acquire infrastructure, but we're not going to acquire anybody with actual rigs running.
So let's talk about the halving. I mean, next April, I mean, this is a really important moment for the industry. How are you preparing for it? How are you bracing your shareholders for what that means and the impact on the business? Like if Bitcoin doesn't, I mean, you know, historically it has appreciated in the run up to the halving, but let's say that doesn't happen, or like regulation proves such a headwind, and we'll talk about regulation in a minute, but let's say that is weighing on the price more than it has during past bull runs. What are you doing to prepare for it? How are you answering to your shareholders?
For us, you know, and to go back on a few of the other themes too, really important to us is controlling our own destiny. And we've actually acquired some sites because hosting is a tough business and we've stepped in, but you have to be able to control it going to halving. And you have to be able to control your efficiency, when you operate, how you operate. Mm-hmm. So all of those factors have their own unique roles. So you can come into an asset, whether it's you acquired it, you build it, and you better be able to have flexibility with that. If you're beholden to somebody else, and this is why the hosting business can be a really tough business, you have an uptime guarantee, even when being up doesn't make sense. So that's why for us, it's all about self-managing our systems. But what that also means is it's about deploying technology, software, things like that can help make your existing machines and your fleet more efficient, whether that's air-cooled or immersion, which we have both. But also, you know, we're in the process, you know, we just ordered more efficient machines and we'll be doing an upgrade cycle between now and then. Now, we don't need to upgrade very much of our machines, but, you know, internally we at CleanSpark really believe that at the end of the day, anything over 38 watts a terahash, when you have, you know, right now the global average I think is about 43. 38 is a tough number when the Bitcoin gets cut in half. A lot of people are going to have to unplug, and if you can stay plugged in and efficient both in your machines and how you operate, that's how winners and losers are going to be selected in this industry. And you have to be ready now, and you should have already started to get ready. I really think over the next year, if you just start now, it's going to be too late because getting capital now is so hard to deploy, and can you do it cost efficient? You're probably going to be on not enough capital to survive the tough times, even if you upgrade to more efficient machines now. So the time was over the last year is what I really think is when you needed to get prepared.
Yeah, I mean, to pile on what you said, the average fleet of miners operates at about 43 joules, 43 watts a terahash. Our fleet, as of mid this year, will be at an average of 24 joules a terahash. So we're prepared by having one of the most energy efficient fleets out there. On top of it, deploying the technology stack that lets you underclock when energy prices are high or Bitcoin price is low, so you get even better efficiency out of the miners. Leveraging the technology stack to really optimize not just the cost of mining, but also things like curtailment. So having very intelligent strategies around curtailment, because for example, you can operate with certain signals in demand response where there might be a price spike, you go offline, it's a 2-hour cycle from kind of initiate to come back online, and maybe that price spike was only 10 minutes long. And so building very intelligent systems that are continually learning based on the specific nature of the market that site is operating at, that can essentially determine there are times where it makes sense to run unprofitably because lots of people will shut off, hash rate drops, you get an extra bump in profit, and it becomes this very interesting learning loop in systems. And I think it really speaks to the miners with scale are going to be the ones that will make it through the halving, because if you don't have scale, you don't have the ability to invest in these systems, new miners, more efficient systems, and also have a very diversified footprint, which is really critical because if you're all concentrated in Texas and one little thing happens in Texas, you're done. And that's why we're very focused on diversifying, Texas, North Dakota, and even now internationally outside of the U.S.
Yeah, we have a saying in our firm, doesn't math up. And it's about evaluating all of the different power programs at all of our facilities and looking at how do we adjust post-halving each of the power programs that we're participating in. And to Fred's point, we have a full stack programming team that manages all parts of our facilities and are managing them in 5 states across 7 facilities. And this is an area where, we're in North Dakota, we're in Texas, we're in North Carolina, we're in pretty much all of the different locations and environments you could possibly experience in the United States. And so it's a reevaluation of, can we participate in more power programs at this location? If so, should we change the machine mix at that specific site? And so that's really what we're doing right now, is really just starting from the beginning and saying, all right, let's evaluate how do we prepare for April. And so to Zach's point, if you weren't already preparing for it, you're a little late, and we've already started moving machines inside of each of our facilities to make sure we're prepared for April.
You take it one step further. So after next year, in 4 years, you're going to cut that price in half again. So does it just become a razor thin, business where you expect razor thin profits? Do you have to then own power generation and become more vertically integrated to be viable? Is it data center diversity, or does that dilute the brand? Like, how do you really, really survive in this industry for the next decade?
I think it's a combination of things. On the one hand, 2028, that halving is going to be hugely impactful on the industry. You also have to look at what's happening to global hash rate. Where is hash rate coming on? Where is there access to energy? But from Marathon's perspective, we're very focused on getting to zero cost energy. And then it doesn't matter when you're mining, because your single largest input cost is zero. So that's kind of the focus strategically of what we're doing, both domestically and internationally, because the question you haven't asked is, well, what happens if you get taxation on energy use for Bitcoin mining?
I mean, 30% tax is being proposed by the Biden administration right now on just that, yeah.
30% tax on zero is still $0. So we believe that owning energy assets in a way that gets you zero cost of energy is what long-term survival in this industry is. Because at that point, halvings really are insignificant to your cost structure.
Do you guys have other thoughts on that?
Yeah, just a few thoughts on that. One of the things is going to be about being a real partner with energy partners, the utilities. Any service provider that operates in this space can really use Bitcoin if they know how. I really think diversification of location of mining is going to be a much bigger deal. And I don't mean that there's going to be a lot of small miners, but big miners and operators are going to have more smaller sites. These big super sites have their benefit now, and they still will in the future, because there's a lot that they can throttle up and down. But we really need to focus, I think, on a long-term basis of scattering throughout a unique utility where you can provide a unique benefit that can only serve that single provider who is managing their section of the grid. And to get really low cost, driving towards zero, you have to provide a really immense benefit. So that's something we're already focusing on now. We're a pretty significant amount of one of the 3 utilities that's in Georgia, and we're scattering our sites. Yes, they're big on a megawatt basis, but we really think on a long-term basis, 5 years from now, we will be such a significant and flexible part of that load that we'll just be providing a service to them, and Bitcoin, Bitcoin will be a big part of our output. But I don't think when it comes to 2028, I think gone are the days where you truly mine 24/7, because the benefit to drive towards the true low-cost power to that true zero, you have to be giving value to somebody else. And so, but because scale will be there, I don't think it will matter. If you're 12 hours this site and 20 hours that site, it will all balance out at the end. But you can't do that without scale. You really need to be one of a large miner, but there still will be diversity and strength in the network because your sites are scattered all over.
Yeah, and I think we should definitely talk about regulation in these last 2 minutes that we have. There's a bill making its way through Texas, which became an epicenter of the industry after China banned its miners, that's viewed as having a largely anti-mining sentiment. New York has passed new rules around proof-of-work mining. And as I mentioned a minute ago, the Biden White House is looking at a potential 30% tax on the electricity consumed by crypto mining operations for its 2024 budget. So how, and we've talked a little bit about geographic diversity, so that you're not the slave to one jurisdiction, and you can kind of get outside of that. But just how significant it is this? Because when you set up these larger footprints, and I think of some of the mines that are out in Rockdale that I've visited, it's not an easy thing to migrate if suddenly you're under new rules that make it more difficult to do business. So are you guys worried about the way things are going in terms of regulation, in terms of rules, in terms of taxes when it comes to the mining industry, specifically in the U.S.?
Yeah, I mean, one of the reasons we started focusing on international expansion was to diversify exposure to the U.S. at the federal level. You have state exposure and you diversify by operating in different states. Our expectation is that over the next 5 years, 50% of our capacity will be offshore. And there are multiple reasons for that. You have energy market dynamics that are different in different places. There are parts of the world where they are generating way too much energy and don't have an offtake for it. And so they're willing to take anything if you'll take off their energy. So we as miners, our business model is to go where the lowest cost of energy. We're the buyer of last resort. And there are still places in the world where there is very inexpensive energy if you're willing to invest in the infrastructure.
Yeah, I mean, for us, it's about the story that we need to tell to all the communities that we operate in, and at a state level and the federal level. A lot of people don't understand. They're like, oh, they've come in and they're taking 50 or 100 megawatts. That's damaging our community. It's like, at the same time, we've hired hundreds of employees. We've invested hundreds of millions of dollars in local communities. And that's an area that story never likes to be told by a lot of politicians. And so it's an area that it requires some education. And I think that's where our industry is really focused right now, is educating politicians to understand that we're out there, we're in local communities, we're investing capital, and we want to be good corporate citizens and good communities citizens as well, to really support every community that we operate in.
The one thing I'll say, since we're running low on time, is to Adam's point, it's important to go in the front door and not the back door when you go into communities. To go in, you're winning the hearts and the minds of the people, and you're providing real value. You go in, I think all of us donate to different communities we're in. We all employ people in the communities. It's about adding more value than you're receiving. And that's really been our focus. And I do think that there's still a lot that can be done to avoid onerous taxes. And I think it's important where you locate. I do think it will come at the state level. We have some headwinds ahead of us, but I think it's all manageable as long as we're always going through the front door and we're engaging with the communities.
Thank you so much to the panelists and to the audience for joining us today, and to the conference for having us up on stage. So thank you all, and have a good rest of the conference.
Bitcoiners, welcome back to Bitcoin 2023. This is the Bitcoin Magazine news desk, sponsored by Marathon. I'm joined once again by my panelists, Samson Mao, Preston Pish, Michael Saylor. In the beginning of the talk, Zach Bradford, the CEO of CleanSpark, mentioned hope is not a business plan. Michael, from a man that owns hope.com, what are your thoughts on this?
Well, I think you got to be optimistic if you're in business. I disagree. Bitcoin is hope. And providing hope for 8 billion people to give them freedom, sovereignty, and property rights. It's a pretty good business plan.
All right. Tossing it over to you, Preston. What was your general take on this panel that we just listened to?
So for people that aren't intimately familiar with mining, I would break it down into 3 different things, and this is what they were kind of talking about throughout the panel, which is cheap energy. You have to have access to cheap energy to be competitive in this very cutthroat industry. You have to have some type of political stability in order to make sure that they don't pull the rug on you. And then the third one is just operational excellence. And so they were talking about efficiencies, and that's really important in order to be able to really kind of compete in this really cutthroat industry. For people that are watching that panel, I think the message to anybody that has any type of political influence and is in a region that has net production of energy, you want these types of people to come into your jurisdiction. You need to set up some type of laws and regulations in order to protect them, to attract them in there, and it's going to strengthen your grid. They're the buyer of last resort, like they said in the discussion. And I'd say that that's my main takeaway, or what I want people to walk away from that is, if you live in an area, net producer of energy, you need to figure out a way to help inform the public servants in your area to set up some type of stability in their local region.
Yeah, there's a great website called WTF Happened in 1971. It seems that there's been a trend of hollowing out the manufacturing industry here. Do you think Bitcoin miners, I'll toss this to Samson, are a great way to bring and onshore a lot of maybe more of that dynamic miners and bring them more here instead of going global and abroad?
Well, I think there's enough mining in the U.S., right? So I think what they're talking about is decentralizing themselves and expanding out of the U.S. And I think it's important for themselves just for survival, because you don't know what the administration is going to do. And if you're that big at that scale, so scale has pros and cons, right? They can shut off at one site and turn on at another site, but they're also going to be stamp outable, right? So if you look at the hash rate right now, 20% is still in China. And I can tell you that 20% are not the big guys that were operating at that scale previously. So it's good that you can decentralize, but I think what you want is smaller scale mining operations instead of big mega farms, because those will be more resistant to crackdowns.
Kind of expanding on that, Preston, do you see Bitcoin miners fleeing the U.S. to other jurisdictions, and is this ultimately good for the Bitcoin network?
I think the main thing that you got to think about when you're thinking about being competitive in this space is you just have to have access to the cheapest energy you can find. And I think that's what the panel was really saying, is that is such a dominant variable in their consideration. So if they're able to get energy at a much cheaper place and they can find it in a jurisdiction that's friendly and has regulations there, they're gonna show up there, and they're gonna show up in style, because that's the thing that really drives their bottom line to remain competitive in this space.
20 seconds to you, Michael. Final thoughts on the 30% tax that's proposed by the Biden administration.
Yeah, I don't think it'll happen. I think it's a non-starter on Capitol Hill. The country needs Bitcoin mining. It's the digital power industry. It's the future, and we're going to come together to support it.
All right. Thank you, everyone. Remember to smash the like button and hit the subscribe button as well. We're going to be going back to the Nakamoto stage for what happened to exchanges. Thank you.